Silver just crossed $100 for the first time in human history, and as I'm recording this, it's already at 115, so that's a 55% move in less than 4 weeks. The fastest monthly gain since the Hunt brothers attempted to corner the market in December 1979. And while CNBC is calling this a speculative bubble and telling you to take profits, I'm going to show you why $100 wasn't the top. It wasn't even the middle. $100 was the moment the paper market finally admitted what physical buyers have known for 18 months. There isn't enough silver. This isn't about silver investors making money. This is about a 40-year system of paper promises finally breaking. This is about banks that sold metal they never had. This is about the Federal Reserve watching a crisis unfold that they have no tools to stop. And by the end of this video, you'll understand exactly why Jerome Powell is trapped, why his term ending in May changes nothing, and what that means for the dollar, for the banking system, and for anyone still holding their savings in a currency backed by nothing but debt. 6 months ago on this channel, I told you silver was going to $80 before the mainstream even acknowledged the supply deficit. That call is now up over 40%. Today I'm going to show you the 3 specific events that broke the paper silver market in January 2026. I'm going to show you the COMEX delivery data that proves the system is fracturing. I'm going to give you the exact price targets based on historical supply squeezes. And most importantly, I'm going to lay out the timeline for what breaks next. Stay until the end because I'm going to reveal the one indicator that tells you when the paper market completely disconnects from physical. It's called backwardation. Silver is already there. And we're closer to a complete market structure failure than anyone on financial television is willing to admit. If you want to understand what's really happening in the monetary system before the mainstream tells you what to think, hit subscribe, because by the time they catch up, the move will be over. Let's get into it. Let's start with what everyone already knows. Silver closed above $100 per ounce on January 20th, 2026. The headlines called it historic. Trading volume hit records. Social media exploded. Year to date, silver is up over 55%. It's outperforming gold by a factor of 3. Mining stocks have doubled. But here's what the headlines aren't telling you. The price didn't break $100 because of speculation. The price broke $100 because the paper market could no longer pretend there was enough physical silver to back the contracts being traded. This is the difference between a rally and a structural break. A rally reverses. A structural break changes the game permanently. Let me explain this simply because it's the key to understanding everything that follows. Imagine a coat check at a restaurant. You hand over your coat, they give you a ticket. That ticket represents your coat. As long as you trust you can get your coat back, the ticket has value. Now imagine the restaurant sold 10 tickets for every coat they actually have. That works fine as long as only 1 in 10 people ask for their coat at the same time. But what happens when 3 people show up at once? 2 people don't get a coat. That's exactly what's happening in the silver market right now. According to data from the CME group, the COMEX, which is the main futures exchange for silver trading, has open interest representing hundreds of millions of ounces. But registered silver, the metal actually available for delivery, has collapsed over 70% since 2020. Between early and mid-January 2026, in just 7 trading days, 33.45 million ounces of silver were physically withdrawn from COMEX vaults for delivery. That's 26% of total registered inventory gone in a single week. And here's what makes it worse. Much of what COMEX reports as available inventory isn't actually available. A significant portion is categorized as eligible rather than registered, which means it's in the vault but not available for delivery. When you strip out the accounting games, the pool of truly deliverable silver is far smaller than the headline numbers suggest. For decades, this fractional system worked because most traders didn't want physical delivery. They wanted price exposure. They would close their paper positions before delivery date and take their profits in cash. The physical metal just sat there, backing paper claims that rarely got exercised. But starting in 2024 and accelerating through 2025, that changed. Industrial users started demanding physical delivery. Sovereign wealth funds started demanding physical delivery. Retail investors, after watching what happened with GameStop and understanding how fractional systems can be squeezed, started demanding physical delivery in unprecedented numbers. The data tells the story. In January 2026, something extraordinary appeared in the CME's open interest reports. Traders holding March silver futures contracts were rolling their positions backward, not forward. They were moving from March to January and February to stand for immediate delivery. They weren't willing to wait 8 weeks for their metal. According to trading desk sources, 850,000 ounces worth of silver longs rolled backward in a single day because they simply could not wait until March to take delivery. When futures traders pay premiums to accelerate delivery instead of collecting premiums to delay it, that's not normal market behavior. That's a bank run in slow motion. Silver breaking $100 wasn't random. It was the culmination of 3 specific events that occurred within 60 days of each other. Each one, on its own, would have been manageable. Together, they were catastrophic for the paper-silver system. The first trigger was China's export restrictions and the explosion in Shanghai premiums. The second was the COMEX delivery crisis and the data showing registered inventory collapsing. The third was the sovereign wealth fund catalyst that announced a massive shift into physical precious metals. Each of these events exposed the same underlying truth. There isn't enough physical silver to meet the obligations the paper market has created. And once that truth became undeniable, the price had nowhere to go but up. Now, you might think the Federal Reserve would step in to stabilize the market. They've bailed out banks before. They've intervened in commodity markets before. They printed $4 trillion during COVID to prevent a financial collapse. Why not do something now? That's the core thesis of this video. The Fed can't stop what's coming in silver. Not because they don't want to, because they literally don't have the tools. Jerome Powell is watching a train wreck in slow motion, and the Federal Reserve doesn't have brakes that work on this particular track. But first, let's look at each of these three triggers in detail. Because the specifics matter. They're not just historical footnotes, they're the roadmap for what happens next. Trigger 1. The China Silver Wall. On January 1st, 2026, while Western markets were still recovering from New Year's celebrations, a new reality dawned in Asia. China's Ministry of Commerce officially added silver to its list of dual-use strategic materials, the same classification previously applied to gallium and germanium. This wasn't a minor regulatory adjustment. This was the construction of what analysts are now calling the Great Silver Wall. The new regulations require Chinese refiners to obtain special state permits to export silver bars or granules. Export volumes have been slashed by up to 40% compared to the previous year. And because China processes approximately 70% of the world's refined silver, this single policy decision fundamentally altered global supply flows overnight. But the export ban was only half the story. What happened inside China revealed something even more alarming about the state of global silver demand. China's only pure-play silver fund, the UBS SDIC Silver Futures Fund, has been halting trading repeatedly since early December. The fund's premium over its net asset value exploded to 68% at one point, and even after regulatory intervention, it's still trading at a 36% premium as of this week. The fund manager has issued near-daily risk warnings. They've imposed subscription limits of just 100 yuan per investor. They've suspended new share issuance entirely. Why? Because they cannot source enough physical silver to back new investments. When you can't buy a silver ETF in the world's largest silver-consuming nation because there isn't enough metal available, that's not a supply chain hiccup. That's structural failure. And the premium data tells you everything you need to know about what's really happening. China's benchmark silver price on the Shanghai Gold Exchange has been trading at a $15 to $17 per ounce premium over London prices. In a functioning market, arbitrage eliminates price differences within seconds. Traders buy cheap in one market, sell expensive in another, pocket the difference, and prices converge. That's market making 101. But when Shanghai is paying 15% more than London for the same metal, and the gap persists for weeks, it means the arbitrage mechanism has broken down. Either the metal can't move between markets, or there isn't enough metal to move. In this case, it's both. Chinese industrial demand, driven by solar panel manufacturing that now consumes over 25% of global silver production, has drained Asian supply. Silver that would normally flow to Western markets is staying in Asia, and with export restrictions now in place, that supply isn't coming back. Trigger 2. The COMEX delivery crisis. If China drained the East, COMEX exposed the West. Here's how silver delivery is supposed to work on the world's largest commodity exchange. You hold a futures contract. You want physical silver. You give notice during the delivery window. The exchange matches you with a seller who has registered silver in an approved vault. Ownership transfers. You can take the metal or leave it stored. Simple, transparent, reliable. At least that's how it's supposed to work. In January 2026, standing for delivery on COMEX silver contracts hit levels that made exchange administrators nervous. The data from January 7th alone shows 1,624 contracts representing 8.1 million ounces received delivery notices. JP Morgan issued 99% of those deliveries. One bank delivering nearly all the silver to numerous receivers scrambling to take possession. But here's what made January different from every previous delivery period. Despite those 8.1 million ounces being delivered, open interest in the January contract actually increased the same day. Buyers were stepping into the COMEX futures market not to speculate on price, not to hedge commercial exposure, but to use it as a physical delivery mechanism for immediate acquisition. The March contract told an even more disturbing story. Traders began rolling positions backward from March to January and February, paying premiums to accelerate delivery rather than collecting premiums to delay it. In a single trading session, 850,000 ounces worth of silver longs moved forward because holders simply could not wait until March to stand for delivery. This is not normal market behavior. This is the behavior you see when participants no longer trust that metal will be available later, and the inventory data explains why. Between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX vaults in just 7 trading days. That represents 26% of total registered inventory disappearing in a single week, not ownership transfers within the vault, actual metal leaving the building. The COMEX responded the way fractional systems always respond when facing a run. They converted eligible silver to registered silver, shuffling accounting categories to make inventory numbers look better. They offered cash premiums to holders willing to accept settlement in dollars rather than metal. Sources on trading desks report premiums of 10% or more being offered to walk away from delivery claims. But the most telling indicator isn't in the delivery reports, it's in the price structure itself. Silver is now in backwardation. That means the spot price, what you pay for metal right now, is higher than the futures price, what you'd pay for metal delivered later. In a normal commodity market, futures trade at a premium to spot because of storage costs and the time value of money. When that relationship inverts, when spot trades above futures, it signals that the market is desperate for immediate supply. It's the commodity equivalent of a bank offering you more money to withdraw your savings today than to leave them deposited for 6 months. Backwardation in silver is a warning siren, and it's been blaring for weeks. Trigger 3. The sovereign wealth fund catalyst China restricted supply. COMEX revealed the system was fractional. But the third trigger is what made $100 inevitable. In the first week of January 2026, multiple sovereign wealth funds, including at least one major Middle Eastern fund managing hundreds of billions in assets, announced strategic reallocations into physical precious metals. Not ETFs, not mining stocks. Physical metal in allocated segregated storage under their direct control. Sovereign wealth funds don't make announcements like this casually. They have teams of analysts, economists, and geopolitical strategists who model scenarios years in advance. When a sovereign wealth fund publicly shifts to physical precious metals, they're making a statement. They're saying they don't trust paper claims. They don't trust Western bank custody. They want metal they can touch, verify, and control. The scale of these allocations is difficult to overstate. Even a 2% reallocation from a $500 billion fund represents $10 billion in purchasing power. At $100 per ounce, that's 100 million ounces of silver demand from a single institution. Global annual mine production is only about 820 million ounces, and multiple funds are moving simultaneously. Within 2 weeks of these announcements, silver broke $100. The sovereign funds weren't the only buyers. Their announcements triggered copycat behavior from institutional investors who had been waiting on the sidelines, unsure whether the silver thesis was real or speculation. Now they had their answer. The smart money was moving. Central banks have been accumulating gold for 3 consecutive years at over 1,000 tons annually. Russia announced a multi-year plan to add $535 million in silver to its reserves, the first major central bank to openly accumulate silver in the modern era. The signal is unmistakable. Nation-states are diversifying away from dollar-denominated assets into hard money. So let's put this together. China drained supply and erected export barriers. COMEX proved the paper market is leveraged far beyond physical backing. Sovereign wealth funds signaled that the largest pools of capital on Earth no longer trust the system. These 3 triggers created $100 silver. But the question everyone is now asking is whether the Federal Reserve can stop this. Can they intervene the way they intervened in 2008? The way they intervened in 2020? Can Jerome Powell pull another rabbit out of his hat? The answer is no. And understanding why requires understanding exactly what tools the Fed has and why none of them work on this particular problem. Let's be precise about what the Federal Reserve can and cannot do. The Fed controls monetary policy. They can raise or lower interest rates. They can buy and sell treasury bonds through quantitative easing. They can provide emergency lending to banks through the discount window. They can act as lender of last resort when financial institutions face liquidity crises. They can, quite literally, create dollars from nothing. That's their superpower. And these tools work for financial crises. In 2008, when the banking system froze because nobody trusted mortgage-backed securities, the Fed flooded banks with liquidity. They bought toxic assets. They backstopped money market funds. They created trillions of dollars and injected them into the financial system to prevent collapse. In 2020, when COVID shut down the global economy, they did it again. $4 trillion in asset purchases, 0 interest rates, unlimited repo facilities. When the crisis is about dollar liquidity, the Fed can solve it by creating more dollars. But here's the problem with silver, and this is the most important sentence in this entire video. The Fed can print dollars, they cannot print silver. When the crisis is about physical scarcity, when there literally isn't enough metal to meet contractual obligations, printing more dollars doesn't help. In fact, it makes the problem worse. because every dollar you print dilutes the purchasing power of existing dollars, which drives more people to seek hard assets, which increases demand for the scarce commodity you're trying to suppress. The Fed's main tool, money creation, is not just ineffective against a silver shortage, it's actively counterproductive. But they have other options, right? Let's examine each one and understand why none of them can stop what's happening. Option 1, interest rate manipulation. In 1980, when the Hunt brothers were squeezing silver and gold was threatening the dollar's credibility, Paul Volcker raised interest rates to 20%. He crushed commodity speculation by making it prohibitively expensive to hold anything other than treasury bills. Silver crashed from $50 to $10. The dollar was saved. Couldn't Jerome Powell do the same thing? No, and the math explains why. In 1980, total U.S. government debt was approximately $900 billion. Today, it's over $36 trillion. The interest payments on that debt are already exceeding $1 trillion per year at current rates. If the Fed raised rates to even 8%, let alone 20%, the interest expense would consume the entire federal budget. The government would have to choose between paying bondholders and paying for Social Security, Medicare, and national defense. Volcker could raise rates because government debt was manageable. Powell cannot raise rates without triggering a sovereign debt crisis. This tool is off the table. Option 2, direct market intervention. Could the Fed intervene directly in the silver market, sell physical silver to push the price down? This is where it gets embarrassing. The United States hasn't had a strategic silver reserve since 2002. The Defense National Stockpile sold off the last of its holdings over 20 years ago. The Fed doesn't have silver. The Treasury doesn't have silver. The U.S. government doesn't have silver. Even if they did, the scale required to meaningfully suppress prices is enormous. Global silver demand exceeds 1.2 billion ounces per year. To make a dent in this market, you'd need to supply hundreds of millions of ounces. China has been accumulating, Russia has been accumulating, India has been accumulating. The United States sold its reserves 2 decades ago. In terms of physical metal, America is bringing a water pistol to a naval battle. Direct intervention requires metal you control. The Fed controls dollars, not metal. This option doesn't exist. Option 3, regulatory manipulation. Here's the one option that technically could work in the short term. The CFTC could increase margin requirements so high that only the largest institutions can afford to hold silver contracts. They already did this. In late December, the CME raised silver margins by over $25,000 per contract. It triggered a brief 15% paper price decline, and then silver resumed its march higher. COMEX could ban new long positions the way they did during the Hunt brothers squeeze in 1980 with Silver Rule 7. They could force cash settlement instead of physical delivery, telling contract holders they're getting dollars instead of metal whether they like it or not. All of this is possible, and if silver goes high enough, they'll probably do it. But here's what happens when regulators manipulate rules to save short sellers. First, it destroys confidence in U.S. commodity markets. International participants migrate to Shanghai, Dubai, or Singapore, exchanges that don't change rules when domestic banks start losing. The COMEX paper price becomes irrelevant because serious buyers trade elsewhere. Second, it confirms to everyone that physical metal is more valuable than paper claims. When the exchange openly admits they can't deliver physical, premiums for actual metal explode. The gap between paper price and real price widens into a chasm. Third, it accelerates de-dollarization. If the rules can change whenever American banks face losses, why would any foreign central bank, sovereign wealth fund, or multinational corporation trust dollar-denominated contracts? Regulatory manipulation might cap the paper price temporarily, but it would accelerate the very trends undermining the dollar's role as the global reserve currency. It's a Pyrrhic victory that destroys the village to save it. The real reason Powell is powerless. So let's synthesize this. The Fed can't raise rates without bankrupting the government. They can't sell silver they don't have. And if they manipulate regulations, they accelerate the collapse of confidence in the dollar system they're trying to protect. This is the first major commodity crisis in modern history where the Fed's tools are not just insufficient, they're irrelevant. In 2008, the problem was dollar liquidity. The Fed could solve that. In 2020, the problem was dollar liquidity. The Fed could solve that. In 2026, the problem is physical scarcity. The Fed cannot solve that. You cannot print your way out of a shortage. You cannot create silver with a keystroke. You cannot force the earth to yield more metal because your banking system made promises it can't keep. Jerome Powell is watching a slow-motion train wreck. And the Federal Reserve doesn't have brakes that work on this track. Now that we understand why the Fed is powerless, the question becomes, what happens next? Here's the timeline. Based on historical patterns and current market data, here's the most likely sequence of events as this crisis unfolds. I'm not predicting exact dates because markets are complex and human behavior is unpredictable. But I can show you the phases, what to watch for in each one, and how to recognize when we've moved from one stage to the next. Phase 1. the paper-physical divergence, now through Q1 2026. This is the phase we're currently in. I call it paper-physical divergence because the price you see quoted on financial websites is becoming increasingly disconnected from the price you'd actually pay to get silver in your hands. Historically, paper silver traded at a slight premium to physical because paper was more liquid and convenient. You could buy and sell futures contracts instantly without worrying about storage, insurance, or transportation. That convenience commanded a small price advantage. That relationship has now inverted. Physical silver commands significant premiums over paper. Retail dealers are charging 25% to 40% over spot for coins and bars. Industrial users are paying double-digit premiums for guaranteed delivery. China's domestic silver price is running $15 to $17 above London's benchmark. The paper price and the physical market are decoupling in real time. The signal that we're transitioning to phase 2 is when physical premiums consistently exceed 50% over spot price. Right now, we're seeing 30% to 40% in retail markets and higher for industrial delivery. The gap is widening weekly. When it crosses 50% and stays there, the paper benchmark becomes meaningless for anyone who actually needs metal. During this phase, something else critical is happening. The silver market is in backwardation. Spot prices are higher than futures prices. That's the market screaming for immediate supply and offering a premium to anyone who can deliver metal now rather than later. Backwardation in precious metals has historically been a precursor to violent price moves. It preceded the 1980 spike. It appeared before the 2011 run to $50, and it's here now. Phase 2, Exchange Intervention, Q2 2026. Phase 2 begins when exchanges are forced to intervene to prevent delivery defaults. We've already seen the opening salvos. The CME raised margin requirements by over $25,000 per contract in late December, triggering a brief paper price crash while physical premiums exploded. That was a warning shot. Based on historical precedent and current inventory drawdown rates, I expect more aggressive interventions between March and June 2026, when the next major delivery periods create another inventory crisis. Here's what you'll see when Phase 2 kicks into high gear. Margin requirements will increase again, possibly by 50% or more in a single announcement. The stated reason will be market volatility and investor protection. The real reason will be forcing leveraged longs to liquidate their positions because the exchange can't source enough metal for delivery. Position limits will be implemented or tightened, preventing large holders from accumulating contracts that could demand delivery. Cash settlement premiums will be offered more aggressively, possibly 15% to 20% over spot, to entice holders to accept dollars instead of metal. And if the situation becomes desperate enough, we could see a repeat of Silver Rule 7 from 1980. That's when COMEX prohibited new long positions entirely, making it illegal to buy silver futures. You could only sell or hold existing positions. The paper price crashed 50% in weeks, while physical premiums went parabolic. The signal for Phase 2 beginning is an announcement from COMEX or LBMA about temporary market adjustments, enhanced delivery procedures, or extraordinary circumstances requiring flexibility. That's exchange speak for we're changing the rules because the system is about to fail. Phase 3, Price Discovery Migration, Q3, Q4, 2026. Phase 3 is when the paper exchanges lose their relevance entirely. If COMEX and LBMA are forcing cash settlement and manipulating rules to prevent physical delivery, they're no longer pricing actual silver. They're pricing a synthetic derivative that has no reliable connection to real metal. Serious buyers, the industrial users who need silver for solar panels and electronics, the sovereign funds protecting national wealth, the central banks accumulating hard assets, will stop looking at COMEX for price signals. Price discovery will migrate to markets that actually deliver metal. The Shanghai Gold Exchange is already the world's largest physical precious metals market. Dubai Multi-Commodities Center is growing rapidly as Middle Eastern and Asian capital seeks alternatives to Western exchanges. Direct miner-to-industrial contracts will become more common as manufacturers bypass intermediaries entirely. During this phase, you could see the COMEX paper price and the Shanghai physical price diverge by 50% or more. The paper price becomes a fiction, a number on a screen that bears no relationship to what real buyers pay for real metal. This has happened before. Russian ruble markets in the 1990s saw official exchange rates diverge completely from black market rates because the official market didn't reflect reality. Venezuelan bolivar pricing became meaningless as hyperinflation took hold. When a pricing benchmark loses credibility, users abandon it. Phase 4, Systemic Contagion, 2027 and beyond. Phase 4 is the scenario nobody in official positions wants to discuss. Major banks have derivative positions across multiple markets: silver, gold, interest rates, currencies, credit default swaps. These contracts often contain cross-default clauses. If a bank defaults on silver delivery obligations, counterparties can terminate all other derivative contracts with that institution. The Bank for International Settlements estimates global over-the-counter derivatives at over $630 trillion in notional value. Silver derivatives are a tiny fraction of that total, but counterparty trust is binary. Either you trust your counterparty or you don't. If banks start defaulting in silver, why would you trust their interest rate swaps, their currency forwards, their credit guarantees? This is exactly what killed Lehman Brothers, not the initial mortgage losses, the cascade of counterparty defaults that made every other financial institution refuse to do business with them. Phase 4 may never happen. It depends on whether phases 2 and 3 are managed carefully, but if contagion takes hold, we're looking at a 2008 scale event, or worse. If you already own physical silver, you've been called a lot of things over the years. A conspiracy theorist, a doom and gloomer, a prepper, someone who doesn't understand modern finance. But you understood something that the sophisticated minds on Wall Street missed. Paper claims on assets are not the same as owning the assets. When the music stops, only those holding physical metal have a chair. Here's what you need to know going forward. Don't sell your physical for paper gains. The entire thesis of this video is that paper currency is losing credibility. Selling silver for dollars is trading real wealth for depreciating currency. You wouldn't sell your lifeboat because someone offered you a nice price while the ship was sinking. Verify your storage. If your silver's in a bank-safe deposit box, understand that banks can restrict access during a crisis. They did it during the banking holidays of the 1930s. They can do it again. If your metal is in a third-party vault, confirm it's allocated and segregated, not pooled with other customers' holdings, and keep at least some portion in your direct physical possession. Be prepared for volatility. If exchanges intervene the way they did in 1980, the paper price could crash temporarily while physical premiums explode. The chart will show silver collapsing. The reality will be that you can't buy physical at any price. Don't panic. Don't sell. Ignore the paper fiction and hold your metal. If you don't own silver and you're watching this thinking you missed the move, you need to reframe your perspective. $100 silver isn't the end of a rally. Based on the supply fundamentals we've discussed, the inventory drawdowns, the backwardation, the sovereign accumulation, $100 might be the starting point for the real move. The question isn't whether you missed $30 silver. The question is whether $115 silver is cheap compared to where this market is heading when the paper system finally breaks. Accept higher premiums. You might pay 30% to 40% over spot for physical metal right now. That's the cost of scarcity. Waiting for premiums to drop means waiting for supply to normalize, and based on everything I've shown you today, normalization isn't coming anytime soon. Prioritize recognizable products. Government mint coins like American Eagles, Canadian Maple Leafs, and Austrian Philharmonics have better liquidity than generic bars. When you eventually need to sell or trade, brand recognition matters. Avoid paper silver entirely. No SLV. No futures unless you understand the delivery process and are prepared to take possession. No unallocated accounts. The entire crisis we've documented is about paper claims being exposed as unbacked. Don't be holding paper when the music stops. Silver breaking $100 is a symptom, not the disease. The disease is a 50-year experiment in unbacked currency, fractional reserve paper markets, and debt-fueled growth that's finally hitting physical limits. Silver is just the canary in the coal mine. It's a small market relative to bonds or stocks or real estate, but it's exposing the same fractional dynamics that exist throughout the entire financial system. The Fed can't stop what's coming because the Fed's tools are designed for dollar problems, and this is a scarcity problem. They can print money, they can't print metal, and as that reality becomes clearer to more participants, confidence in the entire paper system erodes. I said at the beginning of this video that $100 wasn't the top. It wasn't even the middle. Now you understand why. This isn't speculation. This is supply math. There isn't enough physical silver to meet the obligations the paper market has created, and when obligations exceed supply, prices adjust violently. If you found value in this analysis, share it with someone who needs to understand what's happening before the mainstream media tells them it's too late. I'll see you in the next one.